Welcome to Part 2 of our series on the Related Party Transaction Standards formulated by Industry Standards Forum, that is to say, ASSOCHAM, CII.
This presentation is brought to you by K.S. Srinivasan, focuses on the mandatory disclosures, approvals, and information and the key requirements effective from September 1st, 2025. These standards change how listed entities and their subsidiaries prepare and present information on related party transactions to the Audit Committee and, where needed, to shareholders. The objective is to make the information more consistent, comparable, and genuinely decision useful. Let's dive into an executive brief.
SEBI circular dated 26 June 2025 introduces a standardized framework for RPT approval disclosures. It becomes applicable from 1 September 2025 and, crucially, 7 categories of specified RPTs now attract mandatory and enhanced disclosure and deeper scrutiny.
The framework is structured in 3 parts. Part A applies to all RPTs, Part B applies additionally to specified types of transactions, and Part C applies additionally when those specified transactions become material. Certain certifications are also now required from the CEO, MD, or whole-time director, and the CFO confirming that the RPTs are in the interest of the listed entity.
Let's first touch upon the validity of existing approvals. What about the validity of existing approvals?
Approvals obtained for RPTs relating to the financial year 2025-26, including omnibus approvals, and taken on or before 1 September 2025, will remain valid.
These approvals stay valid unless the transaction is materially modified as defined in the company's RPT policy, typically by crossing specified percentage thresholds or absolute value limits fixed by the company.
You mean any such material modification would require fresh approval in line with the new standards?
Next, how do these industry standards apply based on the value of the RPT? Let's look at the applicability of the RPT industry standards based on the value and type of transaction.
For an RPT value less than 1 crore rupees, the RPT industry standards or ISN and the requirements set out in the SEBI circular are not applicable.
When the RPT value meets lower of 1% of consolidated turnover or rupees, 10 crores limits, subject to rupees 1 crore. The disclosure requirements to the Audit Committee divided by shareholders, wherever applicable, confined to the SEBI circular issued on 13 October 2025.
Thereafter, the disclosure requirements based on the category, namely non-specified, specified, or material specified buckets. For non-specified transactions only, Part A is applicable for Audit Committee approval. These are transactions like donations or reimbursement of expenses. For specified transactions, which are below the materiality threshold, Part A and Part B are applicable for Audit Committee approval. And finally, for material specified transactions, all 3 parts, Part A, Part B, and Part C, are applicable, requiring approval from the Audit Committee, the Board, and shareholders.
Let's recap the 7 specified types of transactions under the RPT industry standards. The first category covers sale, purchase, or supply of goods or services, as well as any similar business transactions, including trade advances.
The second category is loans and advances, or intercorporate deposits granted by the listed entity or its subsidiary. The third category is investments made by the listed entity or its subsidiary.
The fourth category covers guarantees, surety, indemnity, or comfort letters, including performance guarantees, given by the listed entity or its subsidiary. The performance guarantee in nature of security divided by contractual commitment, or which could have an impact in monetary terms on the issuer of such guarantee. The fifth category is borrowings made by the listed entity or its subsidiary.
The sixth category is sale, lease, or disposal of assets, or disposal of shares of a subsidiary or associate. And the seventh category covers transactions relating to payment of royalty, including for brand, trademarks, technology, know-how, or management fees.
Now, let's look at the structure of the RPT industry standards. Part A contains minimum information that must be provided for every proposed RPT, whether it is specified or not.
Part B adds further information requirements when the proposed RPT falls in any of the 7 specified types and is required in addition to Part A. Part C then requires additional, deeper information when only if the RPT is a specific type and is material. This is required in addition to Part A and Part B, which is helping the Audit Committee and shareholders assess the risk and fairness of large or sensitive RPTs.
Please note that the RPTs generally undertaken by the listed entity or the subsidiary of the listed entity. Before moving into Part A, the information to be provided for the de minimis value transactions as per the SEBI circular dated 13th October 2025. Hope you are on track and align with my understanding. It includes the minimum information for proposed RPTs. First comes the basic profile of the related party: name, relationship, place, and nature of business, and other basic details. For loans, ICDs, advances, or investments, details of the sources of funds and end use of the funds by the ultimate beneficiary are required. If borrowed funds are used, the amount, nature, cost of funds, and tenure must be disclosed. Such disclosure are not required for banks, non-banking financial companies, insurance, and housing finance companies.
Whereas in Part A, in addition to the above basic information, it includes the ownership of the related party. The relationship between the listed entity or its subsidiary and the related party must be clearly explained, including any influence through directorships, key managerial personnel, or relatives. Direct and indirect shareholding of the related party in the listed entity or subsidiary, and vice versa, should be disclosed, including shares held through entities controlled by the listed entity, the subsidiary, or the related party.
Part A also requires details of historical transactions with the related party. This includes transaction values in the last financial year and the current financial year up to the last quarter, and any defaults by the related party in meeting obligations to the listed entity or its subsidiaries during the last financial year.
In addition, management must present key financial metrics like the related party's turnover, profit after tax, and net worth as per the latest year's standalone or consolidated financials. Alongside this, the value of the proposed RPT and whether the cumulative value of past and proposed transactions makes it material in the current financial year must be clearly spelt out.
The value of the proposed RPT should be expressed as a percentage of the listed entity's consolidated turnover of the immediately preceding financial year. Where the listed entity is not a direct party, the percentage of the subsidiary's standalone turnover and the percentage of the related party's own standalone or consolidated turnover must also be highlighted.
Part A then looks at the basic commercial terms, type of transaction, material terms, tenure, and justification for entering into the RPT. It also asks for details like year-wise breakup of value in case of multi-year transactions, whether omnibus approval is being sought, and any promoters, interested directors, or key managerial personnel interests, and shareholding in the related party.
If any external valuation or other third-party reports have been obtained to support the transaction, copies or key highlights must be shared with the Audit Committee. All of this information, taken together, enables the committee to understand the economic substance and rationale of the RPT before granting approval.
Now let's move to Part B, additional information for specified RPTs. For Category 1, which covers sale, purchase, or supply of goods or services and trade advances, Part B requires clarity on the bidding or tender process, where applicable.
The basis for determining price must be disclosed. For example, whether transfer pricing guidelines or independent benchmarking were used for trade advances to related parties, the amount, tenure, and whether the advance is self-liquidating must be clearly explained.
For Category 2, loans and advances or intercorporate deposits given, the source of funds is crucial, whether they come from internal accruals or borrowed funds. If borrowed funds are involved, the amount, cost of borrowing, tenure, and comparison between the borrowing rate and the lending rate must be provided. The company needs to place the information of borrowings made by the company having similar maturity period vis-a-vis loans advanced to the related party. However, these requirements not applicable to banks, non-financial banking companies, insurance companies, and housing finance companies have specific exclusions.
Part B also requires details on the repayment schedule and terms, security provided, security coverage ratio, and the end use of funds by the ultimate beneficiary. This level of detail helps assess credit risk and whether the terms are at arm's length.
For Category 3, Investments. Part B asks for the source of funds used for the investment and their end use by the investee company. It also seeks disclosure of key terms of the investment and where financial indebtedness is incurred for the investment, details on the nature of indebtedness, cost of borrowing, and tenure, except for certain exempt financial entities.
Category 4 deals with guarantees, sureties, indemnities, and comfort letters. Here, Part B requires the rationale for issuing the guarantee, whether it creates a legally binding obligation, and whether any provisions must be recognized in the books of the listed entity or subsidiary.
It also calls for disclosure of the value of obligations undertaken and key covenants, including any commission to be received and responsibilities in case the guarantee or comfort letter is invoked. This helps assess potential contingent liabilities and moral hazard.
For Category 5, borrowings by the listed entity or its subsidiary, the required information includes cost of borrowing, interest rate, maturity or due dates, repayment schedules, and key covenants. Security details, security coverage ratios, and the end use of funds by the borrower must be clearly articulated.
For Category 6, sale, lease, or disposal of assets or disposal of shares of a subsidiary or associate, the framework requires details of the bidding or selection process for the sale or leasing or disposal of assets other than shares and the basis of valuation. Past 3 years' turnover, profit after tax, and net worth of the business or entity being sold must be disclosed, along with the expected impact on consolidated turnover, profit, and net worth.
The 7th category is royalty payments. Here, Part B requires the purpose of royalty, such as use of brand name, technology know-how, or management fees, and the gross royalty amount on a pre-tax basis. It also expects clarity on the royalty rate, whether it is uniform globally, and the minimum and maximum royalty rates and absolute amounts where there is no uniform rate.
Additionally, the framework calls for details of intellectual property components, brands, patents, technology, and know-how and the royalty amount allocated to each. If there is a sunset clause or time-bound arrangement for royalty payments, that must also be disclosed to the Audit Committee.
Now, let's look at Part C, which applies to material RPTs within the specified categories. For material loans and advances or intercorporate deposits given, Part C starts with the history of defaults by the related party in the last 3 financial years and the value of any existing subsisting defaults. It also asks whether the related party has been classified as a non-performing asset or declared a willful defaulter, and whether any insolvency or liquidation proceedings have been initiated. The latest credit rating of the related party, including structured obligation and credit enhancement ratings, where applicable, must be disclosed, along with any disqualification under Section 29 amperes of the Insolvency and Bankruptcy Code.
For material investments, Part C focuses on debt investments, requiring the latest credit rating of the related party, including structured obligation and credit enhancement ratings. This helps gauge the credit risk of large exposures through investment structures. For material guarantees, sureties, indemnities, and comfort letters, Part C requires details of past and current defaults over the last 3 financial years and the latest credit ratings, along with solvency and going concern assessments of the related party. It also looks at whether the related party has been declared a willful defaulter or is undergoing insolvency proceedings.
In addition, the value of obligations undertaken by the listed entity or subsidiary and the provisions to be created in the books must be disclosed, and whether the related party is disqualified under relevant insolvency provisions. This gives a fuller picture of contingent and off-balance sheet risks. For material borrowings by the listed entity or its subsidiary, Part C requires before and after ratios, particularly the debt-to-equity ratio and the debt service coverage ratio. This helps the Audit Committee understand how the borrowing changes leverage and repayment capacity. For material sale, lease, or disposal of assets or shares, Part C focuses on whether the transaction results in elimination of a business segment or transfer of key intangible assets or critical customers. It also examines whether securities or consideration in kind are being issued to a related party and whether there are significant non-financial reasons driving the transaction. Further, any assets were sold divided by leased out of the same subsidiary or business unit or disposal of shares of the same subsidiary or associate to any related party in the past 12 months to be placed before the shareholders.
And for material royalty transactions, Part C requires disclosure of royalty paid in the last 3 financial years and the royalty as a percentage of net profits. It expects details on how royalty growth compares with turnover and profit growth over those years, and comparison of royalty payments with relevant industry peers where such data is available.
If there are fewer than 3 suitable peers, the listed entity should explain the limits of comparison or the absence of peers. Where the entity forms part of a sectoral index, other constituents in similar lines of business may be used for comparison to give shareholders a sense of whether royalty levels are reasonable.
Before we wrap up, let's summarize what these RPT industry standards achieve. They create a uniform structure for evaluating related party transactions, ensuring that information placed before the Audit Committee and shareholders is consistent, comparable, and useful for decision-making.
The new framework, robust structure for evaluating RPTs. 7 specific categories of transactions now receive deeper scrutiny, and material RPTs trigger enhanced disclosures and approvals, strengthening governance and oversight.
It's going to be an adjustment, no question. For some companies, it means overhauling their processes and training their teams to gather all this information. But on the flip side, it's a real win for transparency and for shareholders who want to know their interests are protected.
By combining financial data, business rationale, risk indicators, and peer comparison, the standards help audit committees and shareholders make more informed judgments about whether proposed related party transactions are fair in the ordinary course of business and in the interest of the listed entity. And honestly, that's the big takeaway. These standards aren't just about compliance, they're about building trust. Thanks for breaking this down with me today. It's been a great deep dive.
Thank you for listening to this walkthrough of the RPT industry standards, effective from 1st September 2025, and this completes the session. We hope this breakdown helps you better understand the updated requirements effective from 1st September 2025. We will connect with you again with a new topic.